Hello, everyone, and welcome to BFW 2401 liquidity and liability risk. And this is actually a part 4. Now, in this part, we will talk a little bit about the sources of liquidity, and we talked about we can have it from stored liquidity, which means from the asset side, or from the liability side. But this is here a little bit detailed, so we will try to cover those things, which is the source of liquidity, which we already talked about it. We said stored liquidity or purchased liquidity. And most importantly, we want to actually discuss the composition, how much we should have from each part in a way that we achieve what you call a trade-off between the risk and the return of these liquid assets. And this is actually coming with this issue of liability management, basically concentrating on the trade-off. Now, I will explain the trade-off when I come to that point. So now what I want to say is, historically, actually, we were using the stored liquidity, which means selling our assets, like cash assets, which is the short-term securities. But now, most of the use and most of the source is actually the purchase liquidity, which is the borrowing, either from the market or from the interbank or from the central bank. Now, the examples of asset liquidity, which is the stored liquidity, we can use cash, treasury, securities, and certificate of deposits, and we can sell those type of assets and save ourselves if we need some liquidity. But if you look, the big part, which is actually used by most banks now, is the interbank market for exchange settled fund. These, what you call it, ESA, is actually held by the central bank. And for all those banks operating under the jurisdiction of the central bank, and then they can top up their accounts or lend to their other banks in just overnight basis, around 25 basis points return. The other thing which we have talked about it is the what you call the repurchase agreements, which is selling and buying securities to central bank. This is another type of source of liquidity. You sell the liquidity now and you buy it later on in a higher price, and the difference is actually your cost. Now, the interbank market is actually a big market, and this can be a worldwide market. It's different from the interbank market for the exchange settlement funds. This is interbank markets, which means all the banks can participate and borrow from each other. And people and bank actually use this source to inject their liquidity. Let me tell you a little bit about the interbank. I think we have talked about it, ESF. Sometimes the account called ESA, Exchange Settlement Account. They hold it by the central bank. Every bank will have account. So all these transactions which is happening during the day, I am, for example, in this country, I am, say, HSBC customer, but I'm using ATM machine and withdrawing from ATM machine from public bank. And in this case, I'm not customer public bank, but I'm using the money of public bank. Now, all these transaction is happening all the day. You are businesses, for example, a business which is RHB is issuing a check from their bank to another customer who is Maybank, say for 1 million. Now, they will take that 1 million, the customer of Maybank, they go and they put it in their account, and actually they will add it to their accounts. But actually, Maybank will take it from RHB when they clear the transaction at night. Every day they do these transactions. So they clear all those transactions among banks within the jurisdiction of the central bank at night in the exchange settlement account. Everybody has to have exchange settlement account under what we call it the exchange settlement funds, where banks actually clear the transactions among their customers and they settle. So repurchase agreement, I think we have mentioned it, which is you sell to the central bank and then you buy later on with a higher price. Interbank market, as I told you, it's a global network utilized by financial institutions to trade currencies and the other currency derivatives directly between themselves. Now, measuring store liquidity is difficult. Actually, it's difficult because you don't know how much you should keep in this type of asset, which is the liquid assets, if you are talking from a perspective of liquidity. And this is actually a function or a trade-off between the liquid assets and between the liquidity and returns. So if you are planning to have more liquidity, then you keep more and more short-term assets, which we call it stored liquidity. And then because the return of those short-term assets, when we talk about government securities and others, is very, very low, but it gives you this privilege of having liquidity in your hand because you can cash it anytime. So it's either the liquidity or the return. So the return, if you are going to keep this money in long-term assets, that will give you more returns, but you will be under liquidity stress and liquidity risk. And also it depends on whether you are able to have a liability liquidity, which means if you decide to invest in long-term and not to keep too much as short-term assets in your stored liquidity, which is those cash and cash assets like treasuries, you should be able to borrow from interbank and other markets if you need liquidity. If you have that ability, then you have this flexibility of investing in long term, and when there is any liquidity problem, you can borrow from the interbank, and you can utilize that source. It depends also in your ability to make securitization, which means sell some of your loans. If you can sell some of your own loans easily, then you can get cash. It depends also on the capital market. If you can access the capital market and you can issue money and capital market instruments like commercial paper, certificate of deposits, and collect cash when you need it. It depends also on if you are going to invest in long-term securities that will give you some type of return. And that return will increase actually your liquidity. So all of those actually issues and considerations when you decide on how much stored liquidity you have. If you are able actually to borrow, to make securitization, to purchase long-term, to use the capital market, you have good amounts, you have good inflow of cash from your long-term securities, then it's not a big deal if you keep less stored liquidity here. This is what they are trying to tell us in this slide. So it's either or. Now, liquid assets, even if you have it, when we say you can trade it in deep market. And deep market, just easily understand it. Deep market means when there is a lot of trading. So you can trade every 10 minutes, every 5 minutes. It's not, which is the market is very, very liquid. When we talk about deep market in finance, we mean there is trading, too much trading and too much of this value. And there is no impact of the price, no impact on the price, even if the trading volume is high. In Australia, for example, liquid assets include treasury notes and treasury bonds. Treasury bonds a long time, but the Australian regulators consider this to be treasury note, to be liquid assets, because you can actually cash it. You can cash it in Australia. Now, liquid securities carry a comparatively low interest rate, but as I told you, when you keep it, you have to have, if you are going to keep it, then you will have a low level of liquidity, which expose you to illiquidity any time. Now, the requirements, for example, in Australia to set how much liquidity you can have, because they have also regulation for liquidity, depends on the concern of the regulators if there is a run on your bank or any bank. So if there is this situation, then they need you to have more liquidity. Also the monetary policy, if they are, the supply of money, if they want you to, if they want to shrink the market, then in this case, they will try to increase the reserves and withdraw much of your, cash assets and cash resources. So they shrink the cash by making those reserve requirements. They can increase it to 10%, 20%. And in this case, they decrease the cash in your as a source in your hand as a bank. We talk about this taxation implication, and somebody would say, what does tax has to do? Actually, when you bought your money in the when the central bank imposed these reserve requirements, when a customer deposit $1 and the reserve requirements, for example, 10% will go to the bank, to the central bank. Now, this is considered like a tax. So if the central bank is actually want to decrease it or make it zero, you know that there will be more liquidity in your hand, and there is no money going to central bank to be held there. So actually, the reserves is actually related to the cash assets. Now, we come back to the trade-off, which is the composition of liquid asset portfolio is determined how much we have should have as a liquid assets. It depends on the how much we are willing to lend and how much actually there is, and how about the liquidity regulations if you take it from the liquidity regulation perspective. Now, historically, many countries had imposed liquid asset ratio. I think Malaysia one, Australia is one. And in Australia, for example, the government securities as a secondary reserve, this one, when you buy T-bills or government bonds, they call it buffer reserves, and you can use it like cash. So in Australia, if they want to measure your how much is your cash holdings and whether you are complying with the regulations or no, they will count the following. They will count the your reserves, and they can cash it if you want. And also you're holding from government securities, short term, like the T-bills or the bonds. They can cash that for you, and this is why it considered a liquid assets. Now, managing the securities portfolio, which is this short-term holdings, is actually an important part in the liquidity management. But still, as we say, the conflict between the balance of risk of liquidity, which is liquidity risk actually, and the desire to maintain high investment return is at the heart of this management, which means how much you want to. So we have the regulation considerations, and we have this issue of return and risk. So if you take the money and invest it all in long term, then your return actually will be higher, but you will be exposed to some liquidity risk. Now, the determinant of financial institution optimal liquid assets actually depends on the variability of deposit inflows and outflows, which means the behavior of the withdrawals of your customers. The yield in the liquid assets, which means the return of the liquid asset. If it is higher, that's fine and good. You can keep more. If it is less, you may decide to shift to long term, but depends within these considerations of liquidity risk and return. Now, liquidation cost also on liquid assets. Like I told you now in the previous slides, if you want to liquidate your assets on government bonds in Australia, they can cash it for you. If you are in other countries and you have this very short term, it depends on whether you are going to lose. So this is another consideration. The first consideration is the flow of cash inside the bank. The second consideration is the return. And the third consideration, if you decide to sell those short-term securities, how long, how is the spread between the buying and selling of those securities? Higher interest rate paid on purchase liquidity. This is also another consideration. If you are going to decide to have very, very less liquidity here in short term, and you want to depend on the long term, it depends also how much is the return that you are going to give for the return or the money market or the central bank liquidating facilities. So these are some of the considerations. So in Australia, actually the Australians have developed, for those facilities of managing liquidity. One of them is which is related to the exchange settlement fund, exchange settlement fund. It's the exchange settlement account, where, as I told you, they have all of this. This is the rates for big transactions. They have the real time where the transaction happens at the same time, which means if I go to ATM machine and make this transaction will be taken from my account directly, which is actually what's happening now. But sometimes for big checks, it takes some time. So they clear it in the exchange settlement account end of the day. But it can be real time. Sometimes it can be real time. Real time has a problems actually, because especially with those people with high trading, checks coming and going, payments coming and go. You can be sometime in a very low during the day in a very low balance, but the second moment or the second 10 minutes, your balance will go up. So the problem with the real time is if they take that consideration and your account goes to zero or below zero, even a little bit, and there is a transaction that will be rejected. So this is why this exchange settlement account is happening end of the day after all the transactions have been settled. So this is for systems. We are only concerned about this system. I think I will show you here, and I don't want you to, don't worry about all of this. Don't worry about it, but this is the process, what's happening. I just want to tell you how this exchange settlement account works. So if you have here bank A, B, C, assuming this is Malaysian banks, maybe this is Maybank, this is Public Bank, this is Hong Leong, and this is RHB. Now, if I am here and I'm a customer here, and you are a customer here, there is a liquidity problem because I am a customer of Bank Delta and give you a check which is here, and you are Bank Charlie, then in this case, actually, there must be a transaction between the two banks, end of the day. So if this transaction is huge, end of the day, because customer one in this D bank paid to customer B and they settled. So the customer here, customer one, will put it in his bank to be credited to his account. End of the day, so customer D has to deduct that amount from customer A and give it to Bank B, who will also settle with, who will put it in customer one in that bank. So actually there is a liquidity if there is a transactions. You can look to this arrow here or here, but if there is a transaction between two customers in different banks, there will be a liquidity settlements in the exchange settlement account. But if this is the case, for example, Bank Alpha, you have customer one, customer B, I transfer from customer A to customer B, nothing will happen to the bank because it goes from one account to another account inside the bank. And this is why you see some of the banks during the weekends when there is high withdrawal, you go to the ATM machine. If you go to your bank, which is the same ATM machine, and you withdraw from the ATM machine, it will give you. If you come from another bank and you want to withdraw from the same machine, they will not withdraw for you because that will take settlement with the other bank. So here, when we talk about liquidity, here and the involvement of the exchange settlement account, there is no liquidity for Bank Alpha. This withdrawal, whether customer A transfer 50 million, customer 2 to customer A, as a bank, your liquidity is not affected. But here, if there is 50 million transferred from customer 1 and Delta to customer 1 in Charlie, now in this case, this customer will use the money and Bank Charlie has to get it from Bank Delta, who will get it, of course, from its customer. So this is how the exchange settlement account. Now we are talking just about the example, but actually when we come to the transactions inside is very huge. I don't want you to worry about it, but exchange settlement account is very important and related to liquidity, because if you don't have, because they settle this end of the day, and they settle it based on they top up banks, banks borrow, and you have to have always a positive account, a positive balance in your account. And this is why it is important to manage this account, and it is related to liquidity. This is just more example. I mean, if there is borrowing, if you don't have enough money in your exchange settlement account, which is this one of the banks, the other banks will lend you and overnight, just overnight, and they will charge 25 basis points interest on the surplus advances. They will pay you 25 basis points, and if they need to top up your account, they also will they charge you the 25 basis points. This is the last slide actually, and this is, as I told you, it's clear how we do the trade-off. Look, this is a CD. Now, what is a CD? CD is a certificate of deposit. What is the nature of this financial products? These financial products, a bank can issue it for a depositor, for investor, but it is for 1 year. An investor will not hold it for 1 year. They will go to the market and discount it among them. They keep discounted. Maybe they want to update their portfolio or whatever, but they keep discounted. From a liquidity risk perspective, this CD holder will not come back to you before 1 year. They issue it for 1 year. But you give this customer high return, usually 5 to 6%. So actually, in terms of liquidity, it is very low liquidity if this is the liquidity risk. Very low liquidity. But in terms of the cost, it's very high. It gets you high. Look at the demand deposits, which is me and you. They gave us less than 1%, 1% and something of return, but we can come and withdraw the money anytime. Anytime we can access ATM machine or go to the bank. And therefore, the financing liquidity from us is cheaper, but riskier. This one is expensive, but less risk. So this is the last slide, and I hope I finished this part. And I will go to the next part, which is the last part. I will see you there. Thank you. Bye-bye.